Morning, everybody. Welcome to the start of a new week, the start of a new quarter, start of a new half year as well. Morning. Hi, Dan. Hi, Neil. Morning, everybody. Well, being the first of the new month, you know what that means, non-farm payroll. For all of those of you who are new to our workshops, the non-farm payroll is the unemployment or employment data in the States. It's a defining one. Hi, David. Hi, Jeff. It's a defining sort of data piece of information that does set the tone. In fact, we've had particularly poor numbers in the US, and in fact, we've had particularly poor numbers really all last week. Let's just open up a browser and get on to things. This is Forex Factory. Hi, Charles. This is Forex Factory. We use this to check out the data. It's got a very useful calendar. Here I have the calendar for this week. I'm just going to quickly go back and show you the data that came out last week, because I know you're thinking, oh God, what's the point in doing that? But it's just quite useful to see where we're at in terms of what's causing the markets to do what they're doing. Particularly poor data, really. We had poor consumer confidence data there. Durable goods was particularly poor. One thing that surprised us last week was the pending home sales. I don't know whether any of you were around on Wednesday, 3 o'clock. That really propelled the markets quite sharply higher last Wednesday. So we had a surprise jump in pending home sales. And as I said to you this time last week on Monday, home sales, very good leading indicator for jobs and economic activity. And with that picking up, some traders jumped on that as a sign that things are going to improve. Typical knee-jerk reaction. One can understand it. But anyway, that was not the surprise of the week. The surprise of the week was the EU summit. I'd sort of dismissed it, and I'd rather poo-pooed it, along with a lot of other people. But in fact, what happened was a complete surprise. The Germans, for some reason, have decided, along with all the other Eurozone members, to an attempt to try and support the markets through funding the Spanish banks directly through the ESM, rather than providing the support or bailout to the Spanish government, and who then provided it to the banks. So that was a very big surprise, in my opinion. Markets reacted typically to that sort of a news, where the euro rallied, stocks rallied, commodities rallied, and I think I think it will also help reduce. I think the other measure was to help reduce Italy's borrowing costs as well. So not just easing the rules on bailouts, the bailout funds for supporting the banks. Also, it was agreed to try and help reduce Italy's borrowing costs. So yeah, so basically you've seen the peripheral bond and equity markets rally. So what I mean by that, I'm talking about the Spanish, Italian, Portuguese, etc. Both their bond markets and their equity markets. So the yield on Spanish bonds, for example, which was around 6.8, 6.9%, probably came off about 50 basis points at one stage. So as the yield comes down, what does it mean by the yield coming down? It basically means that the cost for the Spanish government to borrow money has come down, which is obviously good news. When the yield comes down, the price goes up. So all positive across the board. And equity markets, as we all know, reacted extremely positively. So that was the news. What do I think about it? Well, I guess what I think about it doesn't really matter in a way, but I would say that. And the reason why I put this little article up from the Financial Times, who have got as ever, a tremendously good coverage of all these sort of events, and I do use them a lot. There are comments here that I'll attempt to highlight. Angela Merkel reiterated that she believes such aid should carry conditions. I know this is saying that at one point, the markets gyrated. I think this is very, very important point. The fact of the matter is, the devil is always in the detail. Now, up until now, the European Stability Mechanism, or its predecessor, the European Stability Fund, they only negotiated with sovereigns, with countries about bailouts, etc. I'm not sure how this is going to happen, but one would assume that the European stability mechanism that's now come into being will have to negotiate directly with the banks. Quite what the terms and conditions will be of any bailouts have yet to be seen, but one can assume that they're going to be pretty stringent. And, I've got my doubts whether it's going to be as plain sailing as perhaps the euphoria on Friday might have implied. But as ever, of course, anything with the word euro in it creates all sorts of problems across the board. So I've no reason to doubt that this will create the same sort of problems going forward. But for now, as I said, we've seen all the peripheral bond and equity markets rally and safe assets fall. So when I talk about safe assets, I'm talking about the core Eurozone bonds, the likes of Bunds, French bonds, UK gilts. So, as I said, the safe assets where people have been parking their cash whilst all around us looks very uncertain. So some of that knee-jerk reaction, as I say, caused safe assets to come off on Friday. Okay, well, as I said at the beginning of this piece, an important week. What we're going to do now is we're going to have a quick look at the calendar for the week. Again, we're using Forex Factory. Being the first week of the month, it is, of course, employment week in the States. That's non-farm payrolls. We've got that to look forward to. We've also got a very, very important week on interest rate decisions. So we've got the UK, of course. We've got Australia first thing. And we've also got the Eurozone. That's the ECB. So it's a pretty busy week all in all. So what I will do is just go through the bits of data now so you can decide for yourselves which bits you want to be focusing on and which bits you want to be careful of when you're trading. Okay, so just for starters, we've got the GBP, so cable, an effect on that, potentially at 9:30. We've got the Manufacturing Purchasing Managers Index. I don't know if you remember about a month ago, we got that shock news when we got the 45.9. We were expecting a number of around 49. Anything below 50 is a contraction, so we still have the manufacturing sector remaining very weak, not quite as weak as it was in June, but particularly weak number still. So that is of some concern, obviously. This afternoon, we've also got the manufacturing data, but from the States this time at 3 o'clock. That's the Institute of Supply Management, that's ISM. So that's the Manufacturing Purchasing Managers Index. What this basically does, like our UK number, it tells us the state of the manufacturing sector and as reported by purchasing managers. So they've got a very, anything that's going on in that department, as it were, is indicative of how the manufacturing sector is progressing. If purchasing managers are buying lots of raw materials, etc., you assume that there's a direct correlation between the performance of the manufacturing sector, and that has been particularly weak, apart from in the US. So here we've got a number 52.1. Contrast that with the UK's 46.6. Again, interpreted in exactly the same way. Anything below 50 is a contraction. Anything above 50 is expansion. So you can see again highlighted starkly there the difference between the UK and the US, which has been stronger all year really. Okay, right on to rate decisions. Then on Tuesday. Now, obviously, I don't expect many or any of you to be up and about trading, but we do in the middle of the night. But we do have the Australian rate decision, so that is expected to remain unchanged. The Reserve Bank of Australia lowered the cash rate by 0.25% to 3.5% in line with expectations last month. That's with China's growth stalling and declining commodity prices. So we're not expecting any further moves from Australia. Remember, the Aussie dollar. Any cut could weaken the Aussie dollar further. So for the time being, the market has priced in no cut. So if there is a cut, you could expect to see the Aussie dollar quite a bit weaker come tomorrow morning when we start trading. Next, real key bit of news. We actually jumped. The services sector is not something we're so interested in the UK. Retail sales in Australia. So really we are jumping straight now to Thursday and that is our first news, really, I guess, in the day will be the UK's MPC. There we're expecting rates to be unchanged, but it's not the interest rates that we're focusing on here. I think it's pretty certain that we are going to get a further bout of quantitative easing. So here we have the official bank rate, but in fact it's this bit here, the asset purchase facility. Total of 375 billion so far. I think it's fairly clear that the Bank of England's worried about the recovery, and we are pretty certain now that the MPC will vote to pump further billions of pounds into the economy in an extension to this quantitative easing programme. Really, the only debate, from what I can understand, is how much this will be, whether it's going to be 50 billion or 75 billion added on to this 325 billion. And I know that the MPC minutes that we saw last month on the original vote at the beginning of the month, it was at 5-4 against more QE, so very, very close. And we do know that Sir Mervyn King, the chairman of the MPC, voted in favour of it. And I think there are strong signals now that suggest that this additional stimulus will be voted on Thursday. What does it mean for the markets? Well, we've all discussed it before. Increasing printing money, quantitative easing means printing money, adding to the supply of money, typically will weaken the currency. Bear in mind that we all know what I've been talking about. You can read it in the press. The markets will discount what is expected. So when the expected news happens, typically nothing should happen in terms of the markets because the news has been discounted. So if quantitative easing is not voted on, which I think is going to be highly unlikely, but it's important to discuss this, if QE does not happen, then sterling will rally sharply. If the Bank of England or the MPC only adds 50 billion to the existing 325, sterling will probably rally a little bit. If it's 75 billion, sterling may fall a little bit. So that's something for you to just to consider in terms of that data on Thursday. After that, we've got the Eurozone. Well, God knows. I mean, there's all sorts of things happening in the Eurozone. I was totally wrong-footed by the vote or the EU summit outcome. For now, the Eurozone or the ECB, we were expecting, well, there was the potential for a rate cut last month, and I think this month it looks like, on balance, there will be a rate cut. So you can see I've highlighted here, previously at 1%, we're expecting a 25 basis point cut in the Eurozone rate. And I think that's largely discounted. One of the reasons why that's going to happen this month is that the Bundesbank, which is the German central bank, have really removed the objection to further interest rate cuts because inflation is now falling in Germany. And obviously, there are a lot of economies that are struggling in the Eurozone that really do need a rate cut, and you just need to name all their peripheral economies: Spain, Italy, Greece, whilst it's still a member, Portugal, Ireland, etc. So that's what's going to happen. That's our views on the interest rate decisions this week. Then we're left with the non-manufacturing PMI in the States on Thursday afternoon. That's not such an important bit of data. It's our services PMI, we call it in the UK. The services PMI has become more and more important recently, as it is in the UK, but we know services are doing pretty well. It's the manufacturing that we're worried about. That is the reason why we focus on manufacturing, not because it's more important than services, but it's one that has caused a lot of problems. Other than that, well, let's get on to Friday, the non-farm payroll. That's unemployment or employment to you and me. It is a defining piece of data. This comes out at 1:30 on Friday afternoon. We're expecting a slight improvement, but really not enough really to kickstart things. We had a dramatic slowdown in the previous month, and I do think that this is not enough to get the market excited, and I'm sure eventually we will be having another round of QE in the States, as has been signalled, although no acted on just yet. What happens actually before the non-farm, and something I forgot to mention, we do have some data out on Thursday called the ADP non-farm employment change. So we do get a little bit of a hint of what's to come on Friday. This is a private sector. They actually do payrolls for a lot of companies. So they produce this data because they know the number of employment or employed people because of their own analysis and surveys, etc. So that's looking for a further fall there, which is interesting. Generally, all this data is quite soft, and as I said, it's not enough to prevent, I believe, a further round of quantitative easing. Really, the US should be attracting at least sort of 300,000 jobs a month at this stage in the cycle, so it is particularly weak for the time being. And finally, obviously, the unemployment rate, well, that's probably going to remain static at 8.2%. From 8.1%. I've got 8.2. I had it at 8.1% the last month. But anyway, if it's unchanged, it's unchanged, but nothing spectacular there for now anyway. That's really a summary of the data that's out. So really very much skewed towards the end of the week, everybody. So that's when you'll have to sharpen your pencil. I think for the time being, we just need to try and get over all this news from the Euro summit. We only had Friday really to digest it. I'm a little surprised by it. As I said, a lot of the devil will be in the detail on it. And it's interesting looking at the daily charts on some of these markets like the Euro, like FTSE. We spiked up, challenged those, and the market did settle back quite a lot actually on late Friday afternoon. So I'm not... for the time being, I'm not hugely convinced either way, but certainly the 240 minutes positive, the trade on the euro, I don't know whether Adrian mentioned it to you, but it looks pretty decent myself. Where it goes to maybe sort of the mid 50s. I can even open it up now. Let's have a quick look whilst he's waiting to come through. Yeah, as you can see, the 240 still remains positive, although we've hit this sort of barrier up here. But I think it's likely that we'll probably challenge that again, and certainly looks like from this particular chart on the 15-minute. Let's just quickly expand it. Yeah, so we are starting to move ahead now. So at some stage, my suspicions are that we'll try and have a crack up at this sort of even a high as the sort of 126.70 level, but top of the envelope and maybe 26.40, 26.50 area might be a decent target there. Okay, I'm just going to put you on hold, pass you back. Good luck with the trading for the rest of the week. Exciting week. So a lot of data, as I said, Thursday. So make sure you're flat going into all that those interest rate decisions around midday and 1:45, please. Okay, thanks for listening. Bye for now.